Hello, guys. We're starting chapter 10, the investments. So first of all, what does it mean when we say investments in accounting? It's basically when we spend money to buy long-term assets that we are going to use them for generating profits on the long term or maybe on a short term. So for example, when you buy buildings or lands, or furniture or cars or inventory, this is an investment because you're going to use those to generate profits down the road. But the investments, those particular investments that we are going to discuss in this chapter are not any investment. It's just the security investments. And the security investments means bonds or stocks, okay? Investing in bonds or stocks. We buy them and we either keep them until they mature, or when we sell them, or we keep them until we sell them. So that's how we try to make money. Now, one thing we want to be careful about when it comes to investing in this securities, which means investing in stocks or bonds, it's different from us issuing the stock and issuing the bond. If I'm issuing the stock, my company is issuing the stocks, or I'm issuing bonds, that means I'm raising funds, I'm receiving cash. Issuing stocks, receiving cash, that goes to the equity side in the equation, right? Assets equals liabilities plus stockholders' equity. So that goes under the stockholders' equity when I am issuing the stocks or selling the stocks. Bonds, if I'm issuing the bonds, that goes under the liabilities because I would be receiving that money. But in this chapter, we're not issuing stocks or bonds. We're buying them. It's the other way around. That's why they're not under the liabilities or the stockholders' equity. They're under the assets, okay? This chapter, stocks or bonds that we're buying, they're under the assets, okay? So if I'm buying them, that means I'm spending money. I'm not receiving money. And I'm spending money and I'm receiving a piece of paper that says stock or bond, okay? So why do we buy them? We buy them because we want to try to either keep them for a long term and hopefully the price goes up so then we can sell it for a higher price, or maybe we want to keep it for a long term so that we can receive dividends or receive interest, okay? Now let's talk about the difference between stocks and bonds. Bond is similar to loans. So if I am buying a bond, it's like lending money to the company that is selling the bond to me. Just like if I'm a bank, okay? Banks give loans to people and they receive interest in return. And at some point, they will receive the principal back. It means the loan amount, they receive it back. Same thing when I'm buying bonds. But the main difference between bonds and loans is loans are coming from the banks. Bonds are coming from individuals, from people, from individuals or actually from companies. But it's not a bank. That's the main difference. It's not money coming from a bank. So the company that is selling the bond to me, they're actually borrowing money from me and they have to pay me interest, just like when they go borrow money from a bank and they pay them interest. The difference is they pay interest to me as an individual or as a company who's investing in their company. And then the other thing, bond has to be paid back, just like loans, okay? So when I am investing in a company, buying their bond, I give them amount of money, and after, let's say it's a 5 years bond or 10 years bond, okay? After, let's say 10 years. So after 10 years, they have to pay me back my money. And in between today and 10 years after, they have to pay me interest, okay? So that is the bond. And another difference between bonds and loans, the loan usually has to be paid back with the interest in installments. So when the bank gives loans to companies, companies have to pay back. Every payment will have interest plus a portion of the loan. And then by the time the life of the loan is over, the principal has been paid back already by then. But the bond, all what needs to be paid between the day one and the day it matures, let's say 10 years after, they only have to pay interest. So if I am investing in bonds, the company that I'm the investee, so the company I'm investing in, it's called investee, and I'm the investor. So the investee has to pay me back only the interest in those 10 years, okay? And at the end of the 10 years, assuming 10 years is the life of the bond, at the end of the 10 years, they will pay me back the principal amount that I paid them day one, okay? In between is only interest. That's another difference between loans and bonds. Okay, so back to the stocks. So investing in stocks is also going to be in the assets. That's another part of this chapter. But again, it's under the assets because if I'm buying the stock, for me, it's an investment, okay? It's money that I'm spending for the purpose of investing. Hopefully I will make money out of it, okay? The difference between stocks and bonds, stocks do not have a maturity date versus bonds, they have a maturity date. So if I'm buying a bond, there's at some point that money has to be paid back. But with the stock, you're becoming a partner, okay? You're becoming a partner. So as we probably know that when you invest in stocks, you're not expecting the company to pay you back the amount of money that you invested in their company, because you're partners, like two partners who invest in a company. The company is not committed to pay them back the money they paid for becoming partners. But the bond, when I buy a bond from an investee company, I'm not becoming a partner. Okay, that's the difference between bond and stocks. In their books, I will be under the liabilities, just like loans, just like how if they borrow money from a bank, that will be under their liabilities. Same thing when I'm buying their bonds, I'm lending them money, so I will be under their liabilities. But if I'm buying their stocks, I'm going to be under their stockholders' equity, not liabilities, right? So so that's the main difference. And then stocks receives dividend versus bond receives interest. Again, bond is like loans, right? So I receive interest. Another thing is, because it's interest, not dividends, interest has a specific percentage, interest rate, just like loans, and a specific date for me to receive the interest. So let's say it's a bond that pays interest every 6 months. Every 6 months on a specific day, I will be receiving the interest. Versus stocks, there's no commitment for the company to pay dividends. There's no specific date, right? Or maybe they will decide not to pay dividends that year. So there's more risk for the investor in terms of investing in stocks versus investing in bonds. I'm not saying it's less profitable. It might be more profitable to invest in stocks, but there's more risk of, am I going to receive dividends or no dividends? How much dividends? Is it that much or that much? There's no commitment. But with the bond, I know how much I'm going to receive and I know when I'm going to receive it, okay? All right, so this video is mainly to just introduce the investments in bonds and stocks. I have a couple of slides that I want to show you. Okay, so all right, now let's talk about the different type of bond investments and the different types of stock investments. Okay, so let's start with the bond investment. When it comes to bond, well, first of all, investing in bond, in your textbook, you're probably not going to see the word bond a lot. That you will see the word debt securities, just like here, okay? But keep in mind, debt securities means the bond securities, okay? Investing in bonds. Keep that in mind, all right? There's no any other type of debt securities that we will be investing in, at least in our chapter. Okay, now what are all the different type of bond securities? The first one is the held to maturity. Second one is the trading debt investment. And the third one is the available for sale debt investment. What's the main difference? Again, they're all bonds. The main difference is our intention, all right? Our intention is to keep it until it matures. So let's say it has a 10 years maturity. Is my intention to keep it for 10 years or until it matures after 10 years, or is my intention to sell it before the maturity date, sell it in the financial market? I can't sell it to the investee. I can't go back to them and tell them I don't want your bond anymore, because if it has a it has to finish the life of that bond. If it's 10 years, it has to finish all the 10 years. So if I don't want it, I don't want to keep it for all 10 years, then I have to go sell it in the financial market, just like how we sell stocks in the financial market. Financial market has stocks and bonds, all right? So if my intention is to keep it until it matures, then it's called held to maturity. I want to keep it until the last day of the life of that bond. But if I don't want to keep it, then it's the other two. It's the trading debt investment or the available for sale investment. That's if I don't want to keep it until it matures. What's the difference between trading debt investment and available for sale? The trading debt investment, my intention is to sell it in a very, very near future, okay? I want to buy it for like, I don't know, 2 months, 3 months, and then sell it in the financial market. Just hoping that the price, I'm probably more interested in the price of the bond goes up or down, and then sell it in the market, hopefully for a higher price. My main intention is probably not to receive interest, because probably I will sell it before I even receive interest. Available for sale, I don't want to keep it until it matures. At the same time, I don't have an intention to sell it very soon, but I don't mind selling it, okay? If the price goes up in the market, we sell it. If the price doesn't go up, we will just keep it. So we don't really know if we want to keep it until it matures, or we want to sell it in the near future, okay? So normally the available for sale stays a little bit longer in our assets than the trading debt investment, but at the same time, it's not that long. We don't keep it that long. Like, we don't keep it until it matures, okay? In the next video, we will talk about the journal entries and how each one of those will be recorded. They are different in how we record each one. All right, now next is the equity securities. What is the equity securities? Stocks. All right, so we talked about bonds and stocks. Bond is the debt security, stocks is the equity securities. Now, the three different types of stock securities or equity securities, again, they're all stocks, but the main difference is what percentage of that investee company I'm buying. So if I'm buying less than 20%, that's the first one, then we call it no significant influence equity investment. If I'm buying less than 20% of the company, then it's no significant. It's not that big, right? And the method that we will use when we record the journal entries is called the cost method, all right? Now, the second one is the significant influence. That's when we're buying between 20 to 50% of the company. So it's significant. It's not too small. At the same time, it's not more than half of the company, all right? So that will be significant influence, and recording journal entries will be a little bit different than the first one. And the third one is when it goes above 50%. I mean, think about it. If you're buying more than 50% of the company, you're the biggest owner, right? There's no any other owner in the company who has as much shares as you have, if you have more than 50%, right? So in that case, we're gonna consolidate. So we're gonna use the consolidation method. And even reporting the financial statements will be a little bit different when we own more than 50%. Okay, so that video was just a quick introduction, more in depth in how we record each journal entry, and the reporting will be in the next videos. See you guys soon.